Hey, child, up and go. A big world is out there waiting.
Hi, and welcome to this edition of the Insurance Experts. We'll be interviewing a lot of top specialists and talking about their insurance strategies. In today's episode, I'll be talking about a strategy myself with a personal client for HSA long-term care planning. HSAs can be a good source of funds and can be used pre-tax for long-term care. And we have a great lineup coming soon. We have annuity experts, life insurance experts, disability experts, all looking to share their client strategies with you. Looking forward to this episode. Tomorrow I'll actually be flying out to Madison, Wisconsin, and I'll do some on-the-scene filming at National Guardian Life Insurance Company. That should be a fun episode coming soon. So enjoy this episode, and we'll talk to you soon. Welcome to this next episode of the Insurance Experts. I'll be telling a personal story today about using an HSA funding strategy. I was having brunch recently with my friend Steve. He's a lifelong bachelor. He's 62 years old. We were talking about my business, which is long-term care planning, and I told him that everyone needs a long-term care plan. He said, even me? I don't have a spouse, I don't have dependents. I said, yes, even you, of course. Who's going to take care of you when you're older? So he asked a little bit more about the planning options, and I told him long-term care can be affordable. We can get you just a basic plan design. That can be a great foundation for a plan. Let me show you how inexpensive this can be. Now, Steve's not a fan of insurance. He doesn't own life insurance or annuities, but he took a look at this plan that I was creating for him, and I'll show you in a moment. Here's what it looks like. So I'm designing a plan for Steve, a really healthy single male. We're looking at using his benefits at age 85 years old. That's a commonly used age for long-term care. He's 62 years old right now. And I'd started off by designing a very minimum plan. It's a $32 a month premium. If he pays the premiums over the next 23 years, he'll have paid in about $8,800 in total. And the benefits are about $54,000 in total benefits if he uses them over the course of about 3 years at $50 a day. Now, I usually like adding on inflation protection. The reason I like to do that is the benefits divided by the premium is about 6.2 times protection. When I add on the inflation protection rider, and I'll use the 3% inflation protection rider here, you'll see that you tend to get a little bit more protection by increasing those benefits 3% compounded each year. So he has 111,000 of benefits here. The other thing I know that Steve was concerned about was rate increases. So instead of doing the lifetime premium option, I looked at what it would cost for a 10-year premium option, prepaying the premiums over the first 10 years. And again, roughly the same amount of protection, except he's going to prepay it. So $128 a month paid over the next 10 years. So we started off with the plan design. I chose an annual premium payment option. And then I also extended out the benefit period a little bit. It's not too expensive to add a couple of years of coverage to this, so that if he used all of his benefits, he'd have a little under 200,000 of coverage and about 10.5 times protection. Now, this plan has quite a bit of protection for long-term care, about 10.5 times if he needs all the benefits. But what really made it go was I asked Steve if he owned an HSA, and he said yes, he actually has an HSA accumulating a lot of money in it. I said, did you know that you could use this HSA to fund your long-term care insurance premiums? Steve is actually a foremost leading tax expert in his field, and he actually did a little bit of research, and we found out that he could take out about $4,200 this year, and the number grows a little bit every year. So we actually designed a plan initially that was a very minimal plan, and ended up wanting to max out the amount he could take out of his HSA, ended up doing a much more robust plan that looks like this. Now, when we look at the higher end plans and we notice that he can use his HSA to fund this, we looked at a premium, and I'm going to choose a premium that's $4,500 on this 10-pay plan, and the software program will calculate that this is a roughly $120 initial daily benefit, $237 at age 85 in terms of what's reimbursed to him if he needs long-term care. So this is a plan that's more meeting the needs of his HSA funding strategy. Paid over 10 years would be $43,000 and a little under $500,000 of benefits. So still a really good plan design, now much more robust coverage. Again, largely due to the fact that he can take the money out of the HSA pre-tax, use it to fund the long-term care, and still receive the long-term care benefits tax-free. At the end of the process, it was very smooth. He was a very healthy individual, went through underwriting very quickly. He ended up getting a plan that was actually a very robust plan. And I think this is a good idea that you could share with your clients as well. Thanks for listening to this episode of The Insurance Experts, and we'll be talking to an insurance expert next week about annuity planning strategy. Take care, everyone. Disconnected. Oh no.
What?
Something got disconnected.
Oh.
Hey there, up and girl. This is Mark singing the song 'cause he can't figure out how to trim it the right way. Oh yeah, the right way.